Okay. Peter Rose, Longwood Currency Trading. I'm outside. It's my turn to walk the dog. And I was clipping his nails today, and I clipped a nail too short, and he bled a little bit. So I don't want to take him out on the road or anything, so we're going to go walk in the woods behind the house. But I wanted to do a video discussing some of the differences if you're a trader in the United States as opposed to if you're trading from somewhere else around the world, or if you're a trader in the United States looking at people that are doing videos in another country, because sometimes things change radically. You can see here the snow that we've had over the last, well, we've got probably about 10 or 12 inches over the last 5 or 6 days, and that was mixed in with a sleet storm. And here's the famous snow depth chair, and when it's up to the seat up there, it's about 10 inches of standing snow. It's been a really sunny, bright day today. We've probably melted off. You can look up in the roof on the house and you can see the melting going on down there, and that had about 6 inches of snow on it yesterday, or 4 inches of snow on it yesterday. So I don't know. Anyway, we're gonna walk out. Bo, go, 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 go. And there goes the Bo dog. We're gonna walk up the trail here and let him get some exercise and check his paw every now and then to make sure it's not bleeding again all over the place. So I have a freaking clean up on aisle 14 to do. So look, if you're trading in the United States, there's three sort of different, well, there's a fourth characteristic too. You got to pay taxes on your money. I don't know, some places in the world you don't have to pay taxes on your Forex trading. But the first differential in the United States is you have to put 5% margin up in order to make a trade. What does that mean? Well, if you're trading a full lot, you're trading basically $100,000 worth of currency. Now the price might be 1.60, which would make it $160,000 worth of currency that you're actually trading, but you're basically saying that if you're trading full lots, you're trading in $100,000 increments as a definition of a full lot. Doesn't really make any difference. You can trade a mini lot at 10,000, but you still need 5% of that. So if you're trading a full lot, you need $5,000 as your margin. So that's why the best practices over here in the United States is that if you're going to trade a full lot, you need about $10,000, because you're going to need at least $5,000 on a 1.000 priced currency pair, because that's a $100,000 account. 5% of that's $5,000. Yep. If you're trading a currency pair that's at 1.5000, that's $150,000. Now you got to take your 5% against 150,000. So if it's, you know, you just really have to look at the pricing that's out there to determine how much margin you have. There are some pairs now, because they're so high, USD pairs usually, that you're going to need $7,500 to trade that pair, $7,000. And so if you had a $10,000 account, that would leave you $3,000 of runway, so that you could do your trading based on that. Hey, Bo, where are you? I don't know what he's doing. He's pissed off because I've been in all day, and my wife Sue is off visiting her brother, and he was pissed off that he didn't get to go. So he spent the day with me. Anyway, the $3,000 in your account over the $7,000 is your runway. That's what you have. That's what you have at risk. So if you lose $1,000 3 times, you're done. In other words, you don't have enough margin to trade one full lot. Now you might be able to trade 8 minis, 8/10 of a full lot, or whatever. You can always still trade, but you're still going to need 5% of whatever that money is as your margin. That's kind of a specific United States requirement right now. And look, if you're watching this thing 6 years from now, it might not be 5%, it could be anything. But just be aware that there's differences in the requirements based on where you live. The second thing that's not necessarily unique to the United States, but it is unique among the more reasonable countries, United States, Great Britain, Canada, is that the maximum amount of leverage that you're going to be able to trade is 50 to 1. You could still get 500 to 1 or 1,000 to 1 if you're trading out of some friggin' brokerage in fucking Cyprus or something. But that's just craziness. You can't... Oh, I'm losing the trail here. I don't want to get... Oh, you want to go through the woods? Okay, Bo, we're gonna rough it through the woods. You know all about leverage. If you're watching this video, you know I don't teach beginners, so you understand leverage. And you understand the impact of that leverage and what that means. If you're trading at 500 to 1, it means for every dollar you put up in margin, you can trade $500 worth of currency. And man, I tell you. So, you know, a pair that goes in your favor, you can make a shit house full of money really quick. You get it right and you really know what you're doing, you double that account in 2 days, right? You know, at 500 to 1. But at 50 to 1, it's a little more challenging. 50 to 1 is still really liberal, right? I mean, it's basically you're trading 2% requirement. So your leverage and your margin are two different things that you have to take into consideration when you're developing your trading plan, so that you don't wipe yourself out unknowingly. If you are in a country that offers you 200 to 1 or 100 to 1 or 500 to 1 leverage, don't take it. Don't do it. That's just stupid. Trade at what would be reasonable. And I'm not even sure 50 to 1 is reasonable, but take what you can get where it's reasonable. You can manage 50 to 1 leverage with that best practices $10,000 for a full lot or $1,000 for a mini, and trade at 50 to 1. God, where's that dog? Oh, there he is. He's right behind me. Duh. So you might be noticing my ball cap here. Hell's Backbone Grill. That's in Boulder, Boulder, Utah. It's run by a tremendous chef who happens to be the daughter of my former classical guitar teacher, Walter Spaulding, who died about 6 years ago. And I studied classical guitar with Walter for quite a few years, and I knew his daughter when she was just running around gripping her mom's leg. And anyway, she opened this restaurant with a friend of hers in Boulder, Utah, called Hell's Backbone Grill. And I've been on Hell's Backbone on the roads. If you've ever been in Utah, that's a spectacular thing. But she opened this restaurant. It's got a great story. She's written a couple of books, of which I have. And I found out about Walter's death. His wife had contacted me because she had searched for his name, and I had posted on my website, and so she had reached out to me, and we became close, and we've been communicating through the email for ever since. And that's how I found out that our daughter had opened this restaurant. I said, well, I got to go there. That was on my bucket list. So Hell's Backbone Grill in Boulder, Utah. Check it out. If you go to Boulder, Utah, don't expect it's 5 hours from Salt Lake City over some pretty gruesome roads. And no buses. Boulder, Utah's about 500 people, and no stoplights. I don't even think there's a stop sign. Yeah, this is remote. I think Boulder's about as one of the more remote towns in the United States. We keep track of the dog. Hey, Bo! Here he comes. Ah, he fell in the snow. That's about what I'm going to do. It's been so warm out. I think it's probably up in the 40s today. It was down to 8 degrees just 3 days ago. But it's up to 40 Fahrenheit today. So 32 is freezing, and so 40 it's turning into slush and mush. And so I was out here when it was 8 degrees, and I was slipping around and almost fell. And now it's kind of tough going. My wife was out yesterday and the day before hiking around in this stuff, and she had her snowshoes on, so she did a lot better. But it's tough going when you get it that deep. So we're talking about Sue running through here with her snowshoes. There's the track that she was doing. You can see the snowshoes in the snow. And maybe you can't, I don't know, because it's just a GoPro camera. That's all I'm using. That's the end of it. There's Bo waiting for me up there. That's all we need to do. It's pretty looking back through the woods toward the house. Falling through the snow again here. Currency trading, 50 to 1. Respect the leverage and don't over leverage yourself. Over leveraging means if you had $10,000, you should be trading 1 full lot, but you instead, because you got high leverage, you trade 5 or 4 full lots. That's what the extra leverage means. So if a price moves 1 pip in your favor, it's worth $10 on 1 full lot. It's worth $50 on 3 full lots. Well, if you only have $10,000 and you're not running any margin requirement, because a lot of these countries don't require the margin, they just say, hey, put your money up and trade it 500 to 1, you could be out of juice. I mean, you could run that account right to zero in about 15 seconds on a quick move. You know, the other day I did a video where I was talking about this. Sorry for the camera bouncing. That's me sinking in the snow. I talked about a trade that I ended up making 2.5% on. It binged at me as I was sitting there watching a movie, and I was in for 1 lot, and I kind of ignored it. I said, well, I'll get to that. And then 10 seconds later, bing, my phone goes off again. It's 2 lots. Now I'm 2 full lots in, so I go running into the office and looked at the trading platform, and boom, bang, another lot goes off, a 3rd full lot goes off. Holy shit, man, I got to get out of this right now and take my profit. I mean, I had a profit target way further above that, but when price reacts so violently like that, get out. You know, as it turned out, the price went up in 1 minute. It took it under a minute to go up 70 pips, and it took it about 20 seconds to go down from its peak 37 pips. That is volatility, brother. So when I saw that going on, boom, I jumped out. But imagine if you'd have been on the wrong side of that trade, levered up 500 to 1, I mean, you'd lose your house on that, because a brokerage isn't going to pay that. You're not protected. You're not protected. So there he is, sitting there. So we've got the 5% margin down payment requirement, and we've got 50 to 1 leverage that you need to be concerned about. And here's another unique thing about the United States market. I see a lot of guys that are doing trading videos from outside of the United States that place orders and set the stop according to the different order, so that when one goes, when you hit a limit to peel an order off, that order that they've designated with that particular stop point comes out. Now, it's really helpful for your trading if you're, for example, you're staging in your lots as you go up through the trade, and then you decide, oh fuck, I really don't want that last one, and then you peel that last one off that you put in, because that reduces where your averaged position is, right? You're raising the average as you stage in, so that you're following the price up. But if you peel one off the top, then that average obviously drops back to where the last average position would have been. You know what I'm talking about? Oh, okay. In the United States, you can't do that. It's called FIFO, first in, first out. If you're staging in, the first order you put in, and then you put 3 more orders in on top of that, and then you say, I want to close an order, you don't have your choice. You have to close the first order out. If you don't know that, what happens is that the market is storming away on you, and you go, oh, I want to get out. I want to pull one of my orders off. You know, you say you have an average position of the 3 orders is somewhere, and so I'm going to pull the bottom one off, and then the 2 will remain, or I'm going to pull the top one off and the 2 will remain, and I'll still be okay. But that's not what happens, because the average is now higher than where it was before, because you've averaged in. So now if you pull the bottom one off, you can find yourself underwater. You can find yourself in a positive, rip-roaring, nice position, and if you stage in incorrectly, the FIFO rules will force you to pull. If you're trying to stage out in some kind of an order, those FIFO rules will put you in a situation where you could very easily find your position to have gone negative. Now what are you going to do? You could say, well, how do you get out of your position then? Well, you're okay if the position has gone, if the price is way ahead of where your cluster of stage-ins has gone. The closer price is to the last time you staged in, the more in danger you are of going underwater on that position. But so if the price is way up there and you pull one off, you're okay, because you're still positive. And that's why when I've discussed my trading, I don't stage in. I have begun to stage out based on some of the conversations I've had with my friend Gary Langley. Langer's the scruffy trader, who is a day trader like I am, and he doesn't shoot for 40 pips a day. He's shooting for 10, 20 pips like I do, but his targets are the same as mine. They're 25 to 30 pips out. He's trying to make it there, so he can stage out of those positions, and showed me that there's sufficient real estate in a 15 or 20 pip move that you can stage out. Pull one off at 5 pips, protect yourself, at least put some money in the pocket, and then run the rest. Because before, I'd be all in at the beginning and I'd be all out. Now, one of the situations where I do stage in is, again, something that Langer's does, is he'll stage in reverse. So he'll stage in, he'll put a position on, and 6 times out of 10, the position, as you well know, goes against you. Well, as soon as you put the position on, you're underwater on it anyway, just from the VIG, right? Just because of the spread. So if that position falters and falls back, and you have high confidence in your entry theory, then you stage in another order below where you put that other order in, saying that you're going to go long on this stuff. And then you stage in as you go up. Now when the price advances ahead for you and you start to pull off, your pull off, if you don't have a FIFO rule, really maximizes the control that you have over managing that position. But even if you have a FIFO rule in front of you, if you've staged in on the bottom side, that price is way ahead way up there. There's a bigger differential in price between where the current price is and where the average of the staged in positions is, because you've averaged in below price, below your entry point. So then you end up making more money. And as the price advances up through there, you can even stage in below that. I've done that before. You can get some very spectacular gains. But let me tell you, if you don't have 3 or 4 years of trading under you, you don't even want to freaking think about that. That's just my personal opinion. I know that there's some out there that are teaching beginners how to do those particular kinds of techniques, but I mean, look, if you've done high diving before, you know, in swimming, high diving, you don't take a beginner and put them up on the 4th platform, right? You don't. You're still doing the same backflip off the 4th platform as you are off the 1st platform, but as a beginner, there's too much that can go wrong, and so they don't, you know, you don't do that. It takes your practice to do that. There's things in trading that are being taught in books and in videos and all that other kind of stuff that beginners are looking at going, oh yeah, I see that, I'm going to do that. You have to be very careful. So not only do I have to be careful of that particular stuff, but I think I'm going to take this part of the trail. It's a little easier going. So in the US, you've got 5% margin down requirement. You've got a maximum of 50 to 1 leverage that you're working at, so you better stay within those. Yeah, man, this is tough. You better stay within those 10,000 for a full lot and 1,000 for a mini lot. You have to be aware of the FIFO rules, and then just as a general aside, you got to pay taxes if you're in the United States on your winnings. You don't get away. The tax man is always in the U.S. The tax man is always there to get you. This is becoming more arduous than I had anticipated. Ah, my goodness. So, just some things to be aware of. 5% margin, 50 to 1 leverage, FIFO rules, and you gotta pay the tax man. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.